Hi everybody, this is Bredin of Insanity Industries, and I'm beginning the series today on sophisticated money management. And to start that, I've really got to start with some Theorycraft and talk about how we can achieve what we want, and making sure that our trading methodology achieves what we want, rather than working against us, as can so easily happen. As all my students know, my main bag is money management, and the exact trade execution is something that I'm a little more fuzzy on. I like to say that trading is an about there science, and it drives everybody crazy because they want to know where the best entry is, and I say, well, the best entry is about here. So the development of the money management that we use at Insanity Industries is it's taken a number of years to get right. I've seen something very similar to it alluded to in a number of trading books, but I've never seen it explicitly defined in any formal method, any formal setting, I should say. And one of the guys I've learnt this from calls it space, because it's a very it's easy to see once you draw it out on a chart. It's quite hard to explain mathematically, but once you start drawing it on a chart, you can see what's going on. That aside, we'll go back to the beginning, and this method came out of answering a few questions, and I'll begin that with a little story. Back in 2002, I was speaking to one of Australia's 500 richest men, and we were talking about investing, and he laid down rule one of investment, which was protect your capital. And he said, if I can't work out how to protect my capital, the deal is off instantly. I'm done. Totally uninterested in how much potential profit there is in this, because if I can't work out how to protect my capital, I'm done. And I took that into trading and went, well, if I can't work out how to protect my capital, I shouldn't trade. And from there we come across a second question, which is, how do I use my account leverage to its full potential? And because what's the point of being offered 100 to 1 leverage, 1% per pip, if you can't use it? Because you'd be insane to actually take a trade with all of your account on the line. It's totally, you can't protect your capital doing it. So you have this balancing act between protecting your capital and actually utilizing the leverage on offer. And it could be quite a balancing act if you don't think about this through and look at what's on offer and what you can do. So our first sort of type of money management that people use when they get into trading, we're talking theory crafting here, so there's going to be a bit of waffle before we get to anything of substance. But this is all set up for the thought process behind what we're doing. And the first thing you can do is use no money management at all. And there's lots of traders out there that do it. They just throw a chart and throw a trade on a chart, and what they get into is this idea of they think trading is about pressing the buy button or pressing the sell button. Okay, that's the mechanics of what you do, but it's not actually trading. It's just playing the game. And with no money management, you've got no way of protecting your capital, no idea even how much of your capital is on the line. Which reminds me of many years ago, I was conversing through Facebook while I still used that, and chatting to a girl who was saying, I don't understand it, my account's been almost wiped out in one trade, how did this happen? And I said, well, okay, let's take a look at what you're doing. And she said, pretty much this is the first time I've had a trade not go my way. And I went, okay, no worries, well, tell me what you're doing. And she goes, well, I use a 40 pip take profit, and I trade, I think it was off the end of the US session, so basically into the dead zone between American and Asian session. I thought, okay, that's a bit silly, but all right. And I went, okay, no worries, 40 pip take profit, no worries. And then she goes, oh, and then I use a 300 pip stop loss. And I went, you what? You know, and this is insane. I said, well, okay, you trade EU, as she told me. And she says, yeah. I said, well, let's have a look at a few things here. So on average, you know, the daily range of the EU at that point was about 100 pips or so, maybe 100, 120 pips, something like that. And I said, so what you're telling me is you're willing to hold on to a winning trade for 3 or 4 hours while it covers these 40 pips. She says, yeah, I'm not in a trade for very long. Okay. But you're willing to hold a losing trade for 3 days. And she's like, okay, I don't get you. What do you mean? I was like, oh, gods. Okay. Remember, you know, let your winners run. Get out of losers and let your winners run. Well, it's what you're describing is exactly the opposite of what you should do. No, still nothing there. And I said, well, here's what happened. Now, she'd been told that she should use X percentage of her account, of her account margin to enter a trade. And once I'd done the math on what she said, I said, do you realize that there is 90% of your account between your entry and your stop loss? When you're wrong, you're actually, you know, you're risking 90% of your account to make a trade. You're not protecting your capital. You're putting it all at risk. When you're wrong, you're going to lose the lot. And she said, oh, I'm not very good at mathematics. And I lost my rag at this point, and I just said, then fucking learn. Because in this game, we have to know a certain level of mathematics in order for the thing to work. Otherwise, you have no money management at all. She thought she had money management, but she didn't. She had a disaster waiting to happen. And once we get the idea that no money management is a complete waste of time, we get onto simple money management. And this is where you get, you know, X percent of your account, you know, over a stop loss. And, you know, and that might be, you know, something like, oh, we use, you know, like 1% of our account over 30 pips. Okay, no worries. If you're trading on a small enough chart, 30 pips is probably enough. No worries. And 1% of your account in there. Okay. Well, at 100 to 1 leverage, it's 1% per pip. So you're only utilizing 1/30th of the leverage of your account at this. So you might as well not have all that leverage. I mean, the bit a few years ago where, you know, Americans had their maximum leverage halved made no difference at all to anybody for that reason. None at all. They're still going to risk the same amount of money over the same amount of pips. They're still not trading to their account's potential anyway, so the same guys who were going to blow up their accounts before the change were going to blow it up afterwards. It made zero difference. So we can look at this approach. We're still not answering our questions. How do I protect my capital? How do I use my account leverage? And of course, X percent of your account, it kind of protects your capital, in that what it does is it stops you having a catastrophic loss by making, you know, as you have losers, each of your subsequent losers are slightly smaller in value, and, you know, and you get the exponential decay curve rather than a straight line curve to zero, so you can't actually get to blowing up your account completely, although it has other exponential mathematic problems associated with it, which means once you've taken a loss, it's actually quite hard to get it back again. And we have other simple money management like martingaling, which I'm sure by now everybody knows is when you have a loss, you double down to try to get your account back. You know, increase your lot size after a loss, that sort of thing. And from the Wikipedia page on martingaling, it's got some nice, elegant mathematics to show you that in your coin flip game of, you know, 50% win loss, you know, and some amount of money on the table, double down when you lose, and so forth, carried through to its conclusion of, you know, either doubling your account or being destroyed. of a 50-50 win-loss ratio, you have exactly a 50% probability of doubling your account and a 50% probability of destroying it. In other words, you might as well bet everything on the first coin flip, because that's the same as the long-run outcome anyway. Some quite elegant mathematics about it. It's quite funny to once you sort of get into it and have a look at it. So martingaling we know doesn't work. You've got a 50% chance of blowing up your account. Ridiculous. Moving on. You can't protect your capital, even if you could use your full leverage. So we move from there to this idea of space and how we protect our capital from there. And it's quite elegant. It works, and I'm going to say how we're going to achieve these in the next video. That was just a bit of Theorycraft to get us kicked off so we can start to talk about space, knowing that I'm not talking about any of the other money management methods because they don't protect my capital, they don't allow me to use my account leverage to its full potential. So this has been Bredin of Insanity Industries, chucking some Theorycraft at you in the hope that you'll make more money by sucking less.